It's not very complex, but I created this wealth formula, which breaks it down into a very simple, almost mathematical thing, where it's you take your income, you subtract your expenses, and that equals your investments plus your savings. So if you want to become wealthy, it ultimately comes down to having more investments. Your savings are not there to make you wealthy. They're there to protect you against an emergency. Your investments are what make you wealthy. So if you want to become wealthy sooner, or if you want to become a wealthier,
you need more investments.
You need more investments. How do you do that? Well, if it's your income minus your expenses, it's basic math. Either increase your income, decrease your expenses, or do both.
Right.
So that's the ultimate formula. So now if we talk about, let's break it down step by step on how do you actually do it. 6 steps. And this is no matter what age you are, these are the 6 steps that you want to follow.
Before you get into the 6 steps, what is the mindset that someone needs to think about?
Step number 1 is build the mindset.
My man.
So step number 1 is you need to have the right mindset. And
Okay.
so this is why I call myself the minority mindset and the brand minority mindset, because it's all about thinking differently than the majority of people. Because if you follow what the majority of people do, in 80 to 90% of situations, you're probably doing something wrong.
And you'll be in debt and you'll be paying off debts and loans for the rest of your life.
The majority of people are broke. The majority of people are living paycheck to paycheck. The majority of people are drowning in debt. The majority of people have 0 to no investments. The majority of people are unhappy. The majority of people are miserable. And the majority of people do not like their jobs. This is not me exaggerating. These are all statistical numbers where more than 50% of people feel this way. And so if now you keep doing what everybody else does, you're going to end up like everybody else. And so this is where now you want to think a little bit different and try to find what's right for you and start to get educated yourself. Because when it comes to the mindset, the first thing you have to understand is that it is possible. Because if you're sitting there saying it's not possible for someone like me, somebody who has my background, my parents, my whatever, I can't become successful, I 100% guarantee that you will not be able to become successful. You cannot change your outcome without changing your mindset.
Oh, that's big.
And in the previous interview we had, we talked about mindset versus tool set, where most of the times we assume that the reason why we can't become successful is because we lack the tool set. When in reality, for 90% of people, it's lacking the right mindset. Because when you have the right mindset, you'll discover that the tool set is right around you. So it's first believing that you can do it. Because once you know and believe that you can do it, that belief is going to then impact your decisions. Because now if you say, you know what? Yeah, maybe I can become successful. What are you going to do? You're going to go into YouTube, watch videos. How do I become successful? Then you start watching videos. And now you start to realize, oh, okay, I can start to do this. I can change this about my life. I need to change the way I think. I need to change my actions. I need to do more things in my day. I need to stop watching so much Netflix. I need to do this. Then maybe you start reading books. And now you start reading business books, because I have read a lot of business books, and there's so much wealth in a $20 business book. Just go on to Audible, look at some of the top business books and just start reading them, and you will learn so much. Now you start reading them. Maybe you start doing a little bit. Maybe you don't succeed too much, but you start taking some action and you start to learn even more, because your experiences are some of the best teachers in the world, even if you make mistakes. I have learned from my mistakes. I didn't have a mentor. I didn't have guidance. I didn't have investor family members. I didn't have people telling me how entrepreneurship works. I screwed up a ton. Just like you. We made a ton of mistakes, and that's how we learned. And then maybe you go and take a class. Now you're like, okay, I want to learn how to do this. I'm trying to build this business. I'm doing something wrong. I'm trying to get a better job, or I'm trying to get a raise. I keep doing something wrong. You've read books. Now maybe you find a class. You invest some money in this class, and now you have more education. Now you try more. And now you start to see over time, oh my God, 12 months ago, I had no idea. I didn't even believe that I can do it. Now that I believe that I can do it, I started watching YouTube videos, I started reading books, I started taking classes, I started taking action. And then you keep doing it. Maybe you hire a coach, maybe you hire a consultant. I mean, the list goes on and on and on what you can do, but it all first starts with the mindset, because if you tell yourself you can't, your mind shuts down and you're never going to find an opportunity. You're never going to look for the opportunity. So that's where the mindset is the most important thing. And if you don't have the right mindset, this is where the first thing you want to do is start learning how do I build self-esteem. How do I build my confidence? How do I believe in myself? And I don't have a ton of videos on this. I know you have a ton of videos on this. Watch Lewis's stuff, right? So start there. Then we go a little bit deeper now for focusing on the finances.
So mindset is number 1.
Mindset is number 1. The second thing now, once you build the right mindset, is you want to create your financial base. And the best way to understand this is just to think, if you wanted to build a house, what do you do first? Well, you got to
foundation.
You got to build the foundation. If you want to build a bigger house, If you want to build a bigger house, you want to dig a deeper foundation. You want to build a tall building, you need an even deeper foundation. So you have to start by building your financial base. And what that means financially is first, you want to save $2,000 at the very least. You want to put aside some cash for savings as fast as possible. Because right now, it's something like 40 to 70% of Americans don't have, 40% of Americans don't have $1,000 to put aside, and something close to 70% of Americans don't even have $400 put aside to protect them against an emergency. So most Americans don't have $1,000 put aside.
Get a $2,000 base.
Start with $2,000 as fast as possible.
Yep.
And then you need to cut the financial bleeding. That means your high interest debts, your credit card debts, your hard money loans, your 0% APR loans, which are now charging you 20 to 25%. These need to be paid off as fast as possible because these are loans that are skinning you alive financially.
So, it seems like credit cards are one of the biggest things that hold people back.
Look, credit cards are a tool. They are a tool.
If you're not educated with them, you could get stuck.
If you have this tool without the education, it will burn you. I only spend with a credit card. I spend
a lot of money on
card because I know how to use the tool. And now because I know how to use my credit card, what happens? Well, I don't spend more than I would otherwise because I use my credit card just as a medium of exchange. I'm going to spend this money anyways. Might as well use my credit card. But my credit card gives me perks. It gives me cash back. It gives me fraud protection. It gives me free insurance.
Flights.
It gives me hotel upgrades.
Yeah.
It gives me all these things just because I use my credit card instead of paying with cash. And so now, again, it's the financial education because now some people will say, oh my God, these credit card companies are scams. Well, the reason why they're looked at as scams is because we don't have the right education on how to use them, right? It's a tool without the education on how to use it. And this is where now you have to build that financial education, and many times you're going to have to go out and do it yourself because your credit card company is not incentivized to give you the financial education because they're going to make less money, right? It's profitable to keep people poor. It's profitable to keep people financially uneducated because now if you just keep spending money in your credit card because you have no idea what you're doing, now your credit card company is going to get rich. The average household in America has $6,200 worth of credit card debt. So if you have credit card debt in America, you probably have an average of $6,200. Wow. Now, let's talk about that because
And what's the interest on that?
Well, that's at 15 to 25, 28%. And that's going up.
Every month you're paying that.
You're paying it every month.
So it's not $6,000 a month. It's really, over years, if you never fully pay it off, you're just paying more and more and more.
And the interest rate on your credit card isn't fixed rate. It's variable interest rate. So as the Federal Reserve Bank raises interest rates, the interest rate on your credit card also goes up. So if you are 21 years old right now and you invested $6,200, which is the average household credit card debt right now, if you invest $6,200 right now and you got a 20% return on your money, and you did that for the next 45, 46 years, you are going to retire with $20 million. $20 million. And you never invest another penny again.
Say it one more time.
If you invest $6,200 today, and you never invest another penny again, and
at 21.
At 21, and you get a 20% return on your money, you're going to retire with $20 million.
Wow.
Now you're going to say, Jaspreet, where in the world am I going to get a 20% return on my money year after year? You're right. But your credit card company is doing it every single day.
Wow.
They're charging you. And so when you have that sort of credit card debt, that's you making your credit card company richer. Now, whether or not you think it's a scam, look, let's move past and understand what's going on. That way now you can use it to your advantage. Yes. Because I get tens of thousands of dollars worth of cash back every year from my credit card company because I use it as a tool and I understand how to use it. And this is where, look, if you don't want to use a credit card, it doesn't matter.
Right.
But just don't, if you have credit card debt, you have to pay that off because that is skinning you alive right now. Understand the financial education aspect. So that's the first thing you want to do is create your financial base. So you got to save some cash, then you got to pay that credit card debt off.
Cut the financial bleeding.
Cut the financial bleeding.
What's the strategy if you got 3 credit cards? What's the strategy to getting rid of that debt?
So Dave Ramsey is going to tell you to do something called the snowball method.
The smallest first?
Smallest first
and then
to the biggest.
Because you're building momentum, right?
A financial advisor might tell you the opposite, do the debt avalanche, which is now pay the highest interest rate first and then go down because now you're going to pay off the most interest first. So it costs you the most money in the long term. The reason why Dave Ramsey recommends the snowball method is because psychologically, when you get those small wins of paying something off, you feel like you're winning and you can pay it off faster.
Yeah.
A advisor is going to look at the math and say, hey, look, these numbers are telling me that pay off the higher interest rate first because it's going to save you the most money over the long term. Which one's right? Again, I'm not going to say which one. Do what's best for you. Because I know if I was in a situation, I'm not, I like the idea of paying down the heavy interest rate first because that's how my brain works. I don't need the small wins like that. I can work for the long term. I think, the entrepreneurial mindset where, I know how my mind works. So I understand myself. And this is just honestly being open and honest with yourself. If you can't stay true with it, then do the snowball.
Yes.
It does not matter. Screw paying it off a few months early. Just get it away and pay it off as fast as possible.
But cut the financial bleeding and have a $2,000 base. That's step two. Okay.
That's step two. Now, the next thing you want to do is what I call lead your money. So this is where you want to create a financial system and start investing your money, because your savings will never make you wealthy. You cannot save your way to wealth. You have to invest your money. Your savings won't make you wealthy because of what we've talked about in previous interviews, inflation.
You're losing money in the savings.
If inflation is higher than the interest rate you're getting at the bank, then your savings are effectively making you poorer each and every day, because now your savings are losing value to inflation. Now, does this mean you should not save any money? No. It means you need to save your money strategically. So you want to save your money for 3 reasons and 3 reasons only. Save your money for an emergency. Save your money for a big purchase. If you want to buy a car, you want to buy a house, you want to buy a nice watch, whatever you want to buy, you need cash in order to do that. And then 3, save your money for an investment. If you're not saving your money for one of these 3 reasons, you're saving your money the wrong way, and it is making you poorer by saving that money. So now we focus on the first aspect of saving your money for an emergency. How much do you save? This is now, again, going to depend on your risk tolerance. You want to save somewhere between 3 to 12 months worth of your expenses. And the amount of money you save is going to depend on where you are in life and how much risk you're willing to take on. If you're like, hey, dude, I'm 25 years old. I don't have any financial responsibilities. I don't need that much savings. Fine. Save a few months worth of savings and that's it. Invest more aggressively. If you're like, hey, I have a family, I have kids, I have a spouse, I don't want to take on all this risk, then save 6 months, 9 months, a year's worth of savings, because now it will give you that peace of mind that you have some extra cash put aside. So it's going to depend on your risk tolerance and what you want. But in this lead your money step, this is where you want to understand that there's more to putting your money aside than just saving your money. You also want to be putting your money to work. And the best way to do this is to create a system where no matter how much money you're making, you are going to proportionately continually invest and save based on your income. So what does that mean? Well, one of the simplest things you can do is follow something like
percentage.
My 75, 15, 10 plan, which means for every dollar that you earn, 75 cents is the maximum that you can spend, 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. And this never changes with your income. The only thing that you would ever change is after you hit that savings goal for your emergency savings, you don't keep saving your money for the emergency because you built that whatever months you want, you put that towards your investments.
Yes.
And now, whether you're making 40 grand, 400 grand, 4 million, 40 million, you just keep following the same thing and you're living below your means, and now you're constantly putting money aside for your investments. Now, again, we talked about this before. This investment money can either be passively invested, all of it, or you can put this money aside to be invested. So you can put this money into a bank account. You're looking for a rental property. You're looking for a business to buy. You're looking for a cheap stock to buy. This now depends on your investment goals, right? Where do you want to be invested? How do you want to invest your money? And this is that financial education now of, what do you want to do and your personal goals. If you don't want to be involved with your money, you don't want to be, hey, day-to-day investing or paying attention to the markets, you hate that idea, just passively invest it.
Right.
Put it into low-cost ETFs, index funds, and don't even worry about it and let it do its thing. You don't change it whether the market's up or down. So this is where now you're putting your money to work, leading your money, because real wealth is built through your investments, not through your savings, because you don't want to be spending all your money either. Because if you're spending all your money on the Gucci, the Louis Vuitton, the Beamers, and the extra guac, well, guess what? Gucci's making money, Louis Vuitton's making money, Chipotle's making money, BMW's making money, but you're the one that's making all of them rich. Yes, if you say, I want to become wealthy, but you have no savings, and yet you have all this nice stuff, you'll look rich, but the stuff that's looking rich is making you broke.
Making you broke, yeah.
So, you're paying the price to look rich, which there's nothing wrong with that, but you just have to understand what your goals are. If you say, hey, I don't really care about building wealth, I just want to have nice stuff, it's a free country. It's your choice. But if you say, I want to have wealth, you have no investments and you're spending money on all this stuff, this is where you want to rethink what you're doing and understand what it is that you want and make sure that your actions are aligning with your goals and your lifestyle is aligning with what you want to do. I mean, you can't keep lying to yourself.
That's why you should put your money not in buying the bag, but in buying the stock every month.
Exactly.
Right?
Own the company, own the places where you're spending your money. And, again, there's nothing wrong with having nice stuff.
Right.
What I'm trying to say, just be able to afford it.
Yeah.
You know what?
Don't go on a credit card with it. Yeah.
Don't go into a credit card with it. If you want a nice watch, you want a nice house, you want a nice car, fine. Just make sure you can afford it first.
Right.
And this brings me now to the next step, which I call interest-free living. And now this is where we're going to go a little bit deeper of how do you actually spend your money? Because in the American culture, it is very normal to be in debt. It's very normal to buy things that you can't afford. And before it was with credit cards, now it's with this new thing called buy now, pay later. I'm an entrepreneur. I'm very much involved in the financial space. I'm very much involved in the fintech space. Buy now, pay later over the last couple of years is arguably the fastest growing sector in fintech.
They're crushing it, right?
They're crushing it. I have not invested any money into buy now, pay later apps because I don't believe in it. However,
it's putting more people in the debt, kind of.
The way that they work is you can buy something now and worry about the price later. Now, the pitch to consumers, to people is, well, you don't have to pay any interest.
Kind of like the housing market back in the day.
Right?
It rhymes,
It rhymes. History rhymes, right? But the whole idea that they say is you don't got to pay any interest, just pay it off for, say, 12 months or 6 months, which doesn't seem like a bad idea. Why would I want to pay $1,000 for a laptop today if I could just pay it off in installments and not pay any interest for the next 12 months?
Yeah.
Well, if that's the case, why is it such a fast-growing industry? I mean, no one's going to invest billions of dollars into something if they're not going to see any sort of financial return. I mean, the most expensive kind of money is free money. So if they're giving you money for free, how are they going to make money from it? Well, that's where we dig a little bit deeper.
If you don't get past if you don't pay it in your 12 months, then what?
So that's the first part. If you don't pay it off, now you get slapped with a very, very hefty fine, a very, very hefty fee, where now you're paying a massive interest rate, essentially like a credit card.
They're just acting like a credit card.
It's the same concept where you get a little bit of a grace period. But the second aspect is, if you want to buy a laptop for $1,000 and you need $1,000 to buy it, well, you got to have $1,000. But if you don't have to pay for it now,
you pay $100 a month. Yeah.
You still have the $1,000 in your bank account, maybe $900. And now what happens?
I can go buy more stuff for $100 a month.
And you keep
that's $1,000.
More and more and more. So it allows people to spend even more to lock in all the stuff. So you have a whole bunch of stuff, and now all your money is going out to pay for the stuff that you bought yesterday.
A year ago now.
A year ago. And then if you can't pay it off in time, because that's ultimately their goal, if you can't pay it off in time, now you get slapped with all that interest, all these fees, and now you're the one that's got to pay it off. So this is where you have to understand the spending aspect of how do you spend your money, because again, these things are tools.
I wonder how many people signed up for more credit cards since 2020 and also signed up for bought more things with this buy now, pay later. I wonder if there's data out there on this.
I don't know.
Which will give us a more indication, hey, 12 to 24 months from now, man, people need to either make double the money or they're going to be going into a lot more debt.
So in terms of the number of credit cards, I don't have an answer off the top of my head. But what I do know is the amount of money spent on the credit cards. Because in 2020, when the pandemic hit, we saw the fastest pay down of credit card debt ever.
Really?
Which was great, because now you're sitting at home, you have very little expenses. You don't got to pay a mortgage, mortgages and forbearance. A lot of people are not paying their rent. You don't got to pay your student loans. You're not going out to eat.
You're not going drinking.
You're not going out, right? So you have very little expenses. And then many people are now getting unemployment checks. You're getting stimulus checks. So you have more money coming in. And many people actually became wealthier because of this situation. So you had this extra cash. Some people spent it. Some people invested it. Some people paid down their debt. And we saw the biggest credit card debt pay down in the history of time in 2020, which was
It's all
great
from
news.
free money, though.
Well, at the end of the day, at least you're using it for the right purpose.
it's true.
So that was great.
It's great.
People paid down their debt. Well, then what happened towards the end of 2021 into 2022 was the economy opened back up. People started spending. You wanted to go out and, this pent-up demand. You want to start traveling. You want to eat out again. You want to have fun again. Fine. But then we were also hit with inflation. Everything is so expensive.
Man.
Now you've been waiting to travel. You've been waiting to eat out. You've been waiting to do all this stuff.
And it costs
so much more
more.
expensive. So now what do? Well, I don't got any credit card debt. Let me go put it on my credit card.
Man.
And so over the last number of months, we have seen the fastest growth of credit card debt in the history
Come on.
of time. And this is the situation where we paid it off and now we're going right back into it. Maybe because we feel like, hey, I got room to spend. And second, because everything is so expensive. I can't afford groceries. I can't afford gas. And so it's this whole
It all goes
vicious
back
cycle.
to point number one, mindset.
The mindset, the education. It is so crucial. And this is where now, in this step, you can make that decision. First, you have to understand how to spend your money. And then you can understand now, what do you do with the rest? Do you want to pay down your mortgage?
Right.
You want to pay off, something like that? Or do you want to invest your money? And this is really an individualized question, because the simple math is if your mortgage is costing you, say, 5% a year, and you can get an 8% return on your investment, you can invest your money, get a better return, pay off your mortgage, and have some money in your pocket. It's a no-brainer. So if you can invest your money, get a better return, why would you not do that? Well, because investing comes with risk versus paying off your mortgage does not. Because when you pay off your mortgage, you get a guaranteed 5% return on your money. Because now if you pay it off a year early, you get a guaranteed 5% return. Versus when you invest your money, it comes with risk.
Might go up, might go down.
Might go up, might go down. And so now the question, again, is what type of life do you want to live? Do you want to say, you know what? I just don't want to have to worry about my mortgage payment. I just want to be financially free, never have to stress about money, and just be okay. Then pay down the mortgage. Because now once you pay down the mortgage, your biggest expense is gone. You own your house free and clear. You still got to pay property taxes, but at least now the biggest expense is gone and you're going to breathe so much easier when you don't have a mortgage to pay. But if you say, you know what, Jaspreet, I want to live big. I want to have the nice stuff. I want to have the big things. I want to be flashy. Nothing wrong with that. I want to have it all. Okay, that's fine. Then you don't want to be trying to get a 5% return. You want to invest this money in the markets, you want to invest it in your business, you want to invest this in your education, you want to invest this in yourself, because now you can get a much better return. Is it riskier? Absolutely. But your mindset is somewhere else, right? You want to get a different type of return, and this is why you're investing into the things that can give you a better return, because that's what you want.
Right.
But you just have to understand that it comes with risk. And if you're not comfortable with that, then do the first. So this is where you just have to understand you and understand what type of life you want to live. But the key here is you don't want to put yourself back into the situation that got you here in the first place, where if you have the credit card debt, you got to know how to spend your money, that we don't end up there again. One of the simplest things to do is now to understand the difference between being able to buy something and being able to afford something. And one of the things that I like to say is just follow my rule of 5. If you can't buy 5 of them, you can't afford 1 of them.
The houses are expensive, though.
Well, houses are an exception.
It's different.
So
okay.
we're talking
Everything
about
else.
more our liabilities. You want to buy a Gucci belt. You want to buy a
Gotcha.
$200 Gucci belt. Fine.
Can't buy 5, don't buy 1.
You can't buy 5, don't buy 1.
Gotcha. The house is different.
House is
rule.
different. House is an
Gotcha.
exception. That's the
No
only
one's going to be able to buy a house. Unless you're like,
House is the one exception here, where
Gotcha.
when it comes to your liabilities, that's the only liability that would say it's okay to finance. Because everything else, your Gucci belts,
all that
your
stuff.
clothes, your vacations, you should not be financing that because it's not putting any money in your pocket, and that's a clear liability. You don't want to be financing that stuff.
Right.
So that's where now you want to understand how to spend your money and then where to put your money to work.
Interest-free living.
Yes. And then this brings me now to the next part, which is what I call multiplier income, where, going back to the wealth formula, where it's income minus expenses equal your investments plus your savings. We talked about how to save your money. We talked about how to invest your money. We talked about how to manage your expenses. But now let's talk about the income. Because if now you understand how to live below your means, you understand how to put your money to work. If you want to put fuel on the fire, you just got to earn more money. Now, if you earn $100,000, you earn $1 million, you earn whatever, you earn more money, Now you know how to put this money through your system, through your funnel, whether it's 75, 15, 10, or whatever else. You know how to take this extra money, put it to work. That way you have more money to invest, more money to save, more money to live your life. But the key is you don't want to 100% increase your lifestyle to match your income. You want to increase your income with your investments.
And keep expenses the same.
Keep it ideally. Now you can, marginally increase your expenses, but the key is you want to be increasing your income and your investments way more.
Yes.
So the question is, how do you do that? Well, this is where, again, understand you. If you are an employee, you don't want to start a business, you don't want to start a side hustle, fine. Nothing wrong with that. There's nothing wrong with being an employee. You just have to understand you. But that means now, how can you earn more money? If you like your job, look for ways to get a raise, to get a promotion. See how you can get a bonus. Just be open with your boss. Say, hey, look, I want to be able to contribute more. I want to earn more money.
Right.
What can I do? Most people are going to be very open and honest. Say, hey, I would like you to tack on this, this, and this. Do this, and then we will help raise your salary.
Yeah.
Maybe if you don't like your job, you go and get a certificate. You go and do something else. Now, if the business owner made $1 million but had no other deductions, that was their profit, that's their taxable income, they're going to pay the same tax rate as the doctor, that $400,000 to $500,000 in taxes. However, you have the ability now to harvest debt that the doctor couldn't do. And this means that you'll have the ability to keep money in your bank